Welcome back. Now, a resilient investment portfolio can help one weather various financial storms. And in the current climate of heightened uncertainty, finances tend to be shaky. Luke Meiklejohn, Quantitative Analyst at FNB Wealth and Investments, joins us with insights on how to build a resilient investment portfolio in an environment where tariffs, geopolitical tensions, and other macro and microeconomic factors are at play. Luke, thanks so much for your time this afternoon. And let's start there, right? Talking about navigating, building a portfolio in times of uncertainty, including the economic pressures we are seeing.
Yeah, good afternoon, Tarling, and thanks for having me. Yeah, I think diversification is the core principle that we build our portfolios on. And really, when we think about our lives as South African investors, we are linked to the local economy in many ways. It's where we earn our salaries or own businesses. It's where we live and rent or own properties. It's where we spend our salaries. And that creates a concentration risk to one set of outcomes in terms of economic, political, and currency outcomes. And it's why it's so important that our investment portfolios don't rely solely on one set of outcomes as well. So diversification is about gaining access to different opportunities, which can be driven by very different factors. And really, it's about building resilience into your financial future.
So diversification, the name of the game. Talk to me about the importance of then exposure to these different asset classes. Perhaps you can take me through each.
Yeah, absolutely. So, when we start building portfolios, our goal isn't just return. Obviously, returns are very important, but really it's about risk-adjusted returns and how much risk you're taking to earn that return. So actually, when we think about risk, the risk that matters most to us is the risk of our clients not achieving their financial goals. So we target returns then that are ahead of inflation. We obviously know expenses that we're aiming to meet are going to increase with inflation. And that's the heart of the goals-based investing philosophy that we follow. And so that means building portfolios that maximize that probability of success over time and that can absorb the inevitable shocks along the way without derailing your financial plan. So you want some growth asset exposure, you want equities for long-term inflation-beating returns, but equities are also very volatile, especially when you're going abroad. You've got to think of the currency impact in there as well. And so we'll be blending aggressive growth assets like equities, property, alternative assets, and then balancing that with more defensive exposure like fixed income and cash. And in the current environment, which you aptly described as highly uncertain, something like cash can be very valuable to hold in portfolios to decrease your overall volatility and also to have some firepower standing by to be able to take advantage of opportunities when you see large negative moves in stocks.
And you touched on, holding on to cash in times of uncertainty. What about perhaps putting some money into safe haven assets? How have you been playing that, particularly when it comes to gold? Is it through ETFs? Is it through Krugerrands?
Yeah, no, alternative assets are, I think, very relevant in the current market environment. There's a saying that in times of crisis, correlations go to one. And we saw that in 2022 when both equities and bonds performed very poorly. So building resilient portfolios, I think, requires looking at a broader opportunity set and indeed at alternative assets like gold, which tends to act as a safe haven asset. We've seen that time and time again in many of the great financial crises over time, that investors flock to that. And we quite like gold as a strategic holding. I think trying to time when gold is going to perform or not is very difficult. And so we include gold in our portfolios on a strategic basis, accessing it through ETFs. for the portfolio insurance property that it tends to bring.
And look, when you go about building a resilient portfolio, how do you then also go about making sure that clients are not also emotionally invested or attached to their portfolios, and that we can shift and add and exclude certain assets in your portfolio when they aren't doing well?
Yeah, I mean, I think that our finances do tend to be or bring about very emotional reactions at times. We really don't like seeing losses in our portfolios, as an example. And I think that's why it's so important that we have that goals-based investing philosophy, because it really makes it real about what is that goal that the client has, and what is the portfolio that will give that client the best chance of achieving that over the long term. So as part of that process, it means having someone like a financial advisor who you can talk to during these times of volatility, and get comfort that, yes, there's short-term volatility that's never going to be something that goes away, and maintaining conviction in the long-term outcomes, and really how your portfolio is allocated in terms of asset classes really has the biggest impact on long-term returns.
All right. Luke, thanks so much for your time and sharing your insights with us today. Now, that was Luke Meiklejohn, Quantitative Analyst at FNB Wealth and Investments.